Up next on The Big Spark, as startups find new ways to impress the judges.
I want to franchise this to the world.
We have 10,000 users.
For a share of up to $1 million in seed funding, can they keep their cool when the judges throw curveballs their way?
Do you have a financial slide?
How much revenue have you made so far?
Who will rise above and emerge as our finalists? Find out on The Big Spark, Friday, 8th March, 7 p.m. on CNA, or watch it on demand for free on CNA Insider YouTube and MeWatch. Organised by MediaCorp, supporting Media CNA in collaboration with Elevandi and Thai. Innovation Hub partner Hatch. Official partners Smart Nation Group, UOB, MasterCard, and International. Google Cloud, Oh My Home, M1, Zoom, Circle. Hospitality partner Sofitel Singapore Sentosa Resort and Spa and Royal Group of Companies. Airline partner Singapore Airlines. Knowledge partner Ecosystem and supporting partner Constella.
You're listening to a CNA podcast.
Hey, it's Andrea Heng on the Money Talks podcast. Quick question. Which of these apps do you use each week? Facebook, Amazon, Google? If you're like me, the answer is almost every day. Yep, that's right. Don't judge me. But that's what we'll be getting into this week. Why are they the biggest and currently best performing tech stocks? And should you be putting your money into them right now? I'm going to get into that in a few minutes. But first, I have a favor to ask of you. If you haven't already followed us on Spotify, Apple Podcasts, or YouTube Music, please do, because that way you get an alert the moment a new episode drops, all right? Okay, so let's get started with some financial news that caught our attention this week. And of course, I will need to bring in the assistance of my editor, Tiffany Ang. Hey, Tiffany.
Hi.
All right, so what are we discussing first?
Okay, so first, our favorite anti-hero pop star is in town. I'm not a Swiftie. Are you a Swiftie?
I'm not a Swiftie, but you know what? I have to admire her business sense.
Yeah, I must say so, yeah. And already we're starting to see what's known as the Taylor Swift effect.
Oh, yeah.
So a bit of background. In an interview, the Thai Prime Minister said that Singapore paid a handsome grant to Taylor Swift's team to woo her here for an exclusive Southeast Asia stop. So that got many people asking, how much did we pay and is it worth it?
Yeah, you know, it may seem like a dig at Singapore, but it is a valid question, right? So the Singapore Tourism Board didn't really disclose how much they gave in grants, right? And never did.
No, they didn't. But hotels and airlines told CNA that demand for flights and accommodation around the concert dates have gone up by 30%.
Wow. Okay, that makes sense because Singapore is one of only 2 stops in Asia for Taylor Swift, the previous one being Japan. And we have 6 shows here in Singapore, completely sold out. Okay, so we're probably expecting lots of fans coming in from Malaysia, Indonesia, Philippines, Thailand, and disappointed fans in Australia maybe who didn't get to catch her in the Australia Eras tour.
Yeah.
We might see them too.
Yeah. So back to the question, is it worth paying a grant to Taylor Swift's team? I mean, I suppose if you see that the concerts can be a big source of revenue for the country, then yes. So earlier on you mentioned Japan, right?
Yeah.
Researchers estimated that her tour in Tokyo generated up to $227 million for Japan.
And they have fewer shows than we do.
Exactly. And they are also predicting that the concerts here in Singapore will exceed the estimated $787 million in economic value from Taylor Swift's time in Melbourne.
That is insane.
Yeah.
You know what I'm thinking? I think it's time to look at stocks in the hospitality and travel sector perhaps because that's likely to go up. So if you happen to be able to have that flexibility to move around, this might be the time to do it. And don't forget, we still have a lot of major concerts and events coming up in Singapore,
this year.
Not just Taylor Swift.
Yes.
Yeah.
Yeah, and speaking of up, you know what went up to? Junior bank staff bonuses.
What am I doing in this job? That's what I ask myself every time I see headlines like this. But you know what? Congratulations to you if you are working in a bank. It's a great bonus for you.
Yeah, so specifically OCBC, DBS and UOB all announced a one-off bonus for their junior staff.
Junior.
Junior. So this is to help them cope with rising living costs. OCBC and DBS are giving their junior employees $1,000 $12,000 each Singapore dollars, while UOB junior staff are getting an extra month of bonus.
Wow. No guesses where all of that bonus is coming from. I think banks had a fantastic year with all the interest rate income that they've been generating over the past couple of years. I think this is a good move. It's a bit of a thank you as well for people who stuck around and worked behind the scenes. Lots of work for banks that were kept busy for the last 2 years or so. Now, if you're listening to this and you would like a nice bonus too, just like me, you can tag your boss, just like I will not. I hope you get that bonus anyway. Good luck. Did you know that the number 7 is considered a lucky number in Japan? Perhaps that's why the biggest and currently best performing tech names in the stock market are dubbed the Magnificent Seven. But they weren't always called that, you see. Tech stocks had their beginnings actually as FANG stocks: Facebook, Amazon, Netflix, Google. FANG. FANG evolved into Fangum, not as cool, because Apple and Microsoft joined the league, Netflix dropped out, and then Tesla and Nvidia joined to form what's now called the Magnificent Seven, or, if you're cool like me, the Mag 7. And for that, we can thank Bank of America analyst Michael Hartnett, who coined the phrase in 2023. He was describing the 7 tech companies dominating the stock markets. But you know what? Anything shiny is vulnerable to losing its luster. And the Mag 7, they aren't immune to this. So while tech stocks are having a moment, we should also take our moment to consider the risks and rewards of investing in Mag 7 stocks, what your game plan should be if you're already there. To help us with that is Jonathan Wu, Senior Equity Research Analyst with Phillip Capital. Hey, Jonathan, thanks for coming.
Thanks for having me.
So, in just a span of about 3 years, so much has happened to big tech, most of them making up the Mag 7. What are the factors that are driving these Mag 7 stocks to their current strength?
So first of all, would be revenue growth, right? I mean, obviously, you've got a lot of demand from consumers for a lot of these big tech companies. If you just think about a couple of them off the top of your head, Meta and Google. Everybody uses Google nowadays every day for countless hours. Everybody's watching YouTube.
Yep.
People on Facebook, if they're not on Facebook, they're on Instagram. Netflix, everybody uses Netflix. Now they've kind of been taken out of the Mag 7, but you get the point, right?
Yeah.
So a lot of consumer demand, that's really driving a lot of the growth for a lot of these tech companies.
So they've had quite the journey from the dot-com renaissance that we saw in the early 2000s, right? And then they had the COVID-19 pandemic surge, right? So they were pandemic darlings because everyone was stuck at home. They had to use Netflix. They had to use their phones. They had to use their Facebook to stay connected with their friends and family. But then we saw a painful tumble after those COVID-19 restrictions were eased. Now there's a sustained outperformance in the market. I'm most curious about this current stage we're seeing right now, the early months of 2024. How was it that they were able to make that stunning recovery from down in the dumps post-pandemic, which was only, 1.5, 2 years ago, to where they are now?
So I think it's a couple of things. Firstly, when the dip happened, you kind of saw growth slowing down a little bit. And then they were still kind of expanding. So they're still spending a lot of money on headcount, on a lot of projects that were long shots. But at the time, because growth was going so well, they had enough cash to do it.
Right.
So that kind of sent them tumbling down a little bit. And as they focused towards efficiency throughout the most of 2023 and even now, they cut a lot of their fat off the bone.
Yeah.
They're much leaner. They've got a lot of operating leverage, and demand has actually returned or remained consistent at least.
Yeah.
And so that's what fueled the rally a little bit. Plus, you have this AI effect. Everyone's really hyping about it.
Yeah.
Personally, I think it's less of a game changer, more of a game improvement kind of tool. I don't really think it's that significant at this
Right.
point in time.
So it's not as revolutionary as people are making it out to be. That's what you're saying.
Yeah,
Okay.
it's probably similar to like Office 365 when it came to market.
Yeah.
It's good. It'll make your life better. It'll increase efficiency.
Yeah.
It'll
But
run
it
a lot of
didn't change
tasks.
your life all that much.
Yeah.
Okay.
Yeah.
But do you think, though, at the mild pace and position that AI is throwing itself into the tech names and the tech industry, how do you think that is going to shape the path forward for the Mag 7 in terms of their stock performance and their growth?
I think in the near term, it'll still be a driver because there's still hype around it. Take a look at Nvidia, for example.
Yeah.
They feel the immediate benefits and immediate effects of increasing AI demand because they supply the chips, right?
Yeah.
And you can see the backlog is still increasing quarter on quarter.
Yeah.
There's still so much demand. And so until this kind of dwindles down and enterprises stop spending on AI, or at least stop increasing spending in AI, which is we're still kind of far away, because right now you're seeing a lot of not just enterprises but a lot of sovereign nations. They're starting to build out AI infrastructure, getting out their own AI models.
Everyone's kind of playing catch up now.
Yeah.
So that backlog is where the money's at.
Yeah, so that's really driving the demand for AI products. And so that helps NVIDIA, helps Google, helps Amazon because of a lot of the cloud infrastructure that is needed. So that is really the main kind of revenue driver in the near term.
Okay.
I'm not sure when the demand will subside because it's getting a bit out of hand right now.
I'm inclined to agree. I mean, this AI hype is really out there. It's really hard to ignore. Now, speaking of NVIDIA, I'm glad you brought it up, because looking at the charts of the stock performance of the Mag 7 over a 3-month period, 1-year period, and 5-year period, the first whopping number that sticks out to me is NVIDIA's stock. I mean, the 3-month percentage change shows 12.35. To the 5-year percentage change is 1,094.64. What's causing this crazy spike?
A big part of it is expanding valuations. People expect a lot more growth out of them.
Okay.
So that just drives price up immediately.
Right.
You compound that with a lot of operating leverage that companies, like NVIDIA has. They don't have to spend a lot to drive revenue growth. They don't have to increase their operating expenses that much. They don't really have to invest that much in capital expenditure. So their cost base is relatively fixed, more or less.
I see.
So revenue just translates to earnings. Any additional revenue just translates to the bottom line. And you see this big spike there. And that's what you see with a lot of tech companies, and compared to maybe traditional businesses like consumer products like maybe Coca-Cola or McDonald's, right? They don't really have this kind of leverage where one additional revenue dollar translates to 80 cents on the bottom line, right?
Yeah.
So that's really the main kicker.
Okay.
If demand slows down, naturally you start to see earnings kind of slow down a little bit.
Okay. Is this what will spell volatility for the tech sector? Is this why they're so volatile?
Initially, yes, because at the same time, a lot of these companies are still in their growth stages.
Right.
So, exponential growth, exponential expansion.
Right. So they're kind of like adjusting, not just to demand, but also to what they need to do in order to expand.
Yeah.
Okay.
Yeah. So once this growth kind of slows down, and we're actually seeing it a little bit with the more mature companies like Meta, Google, Apple especially.
Apple's very mature, actually. Yeah.
So growth has kind of slowed down a little bit. I mean, they're still growing faster than the average company on the S&P 500, but it's no longer your 30-40% year on year.
Okay.
So you're starting to see these companies slow down a little bit and mature a little bit. Whereas on the back end of the Magnificent Seven, Tesla, NVIDIA, they're still relatively newer compared to Apple, right, for example. And so they are a little bit earlier in their growth stages, so there is a little bit more room to run for them.
I see. So it's not necessarily that NVIDIA and Tesla have better value growth. It's just that they're newer players in the game.
Yeah,
and that explains the exponential increases that we're seeing.
Yeah, it's just where they are in the business cycle and where they are in the consumer demand cycle.
Okay, well, that's a really good explanation. Now I have a clearer idea of why certain names are just performing better than others. It's not necessarily an outperformance per se. It's just where they are in their business lifespan, right?
Yep.
So one thing that I want to know is, how much do these guys cost me? If I want to buy Alphabet, if I want to buy Apple shares, how much am I looking at? Because if they're so high, does it become unsustainable and too expensive to buy? Are they worth it?
So price is just one element of it. I mean, it's all relative. So what you're really looking for when you talk about value, most of the times you look at ratios. So price to earnings ratios, price to sales ratios, and you look at it as an industry whole and what this company is priced at versus that particular industry.
Right. What would something like price to earnings ratio tell you as an investor?
So it gives you basically an idea of whether a stock is overpriced compared to its peers or undervalued.
Right.
So it's a relative valuation. Let's say NVIDIA right now is priced at about 40 times forward earnings, forward price earnings.
Yeah.
You can't compare it to a company that has much lower growth and maybe has a price earnings ratio of 8 times if they're in a totally different industry and in a totally different part of their business cycle and growth stage.
Right.
So it's all relative.
Okay.
Yeah,
it's not straightforward.
Yeah, when you look at the stock price, it really doesn't tell you anything because it doesn't mean that because Nvidia is $700 versus Apple that's over $200,
Yeah.
it's more expensive.
Yeah.
It's just a relative
Right.
term.
So, what other factors should an investor consider then when deciding which of the Mac 7 stocks to buy?
So I think firstly, you got to figure out where's the demand flowing to right now. So if you look at the 7 of them, by far the weakest one would probably be Apple, actually.
Yeah.
Because everybody kind of has an iPhone.
Yeah.
The only way they grow their iPhone revenue is when people upgrade their iPhones, right? So usually you've got this 3 to 4 year cycle. And over the last few years, they haven't actually raised their prices on their Pro models or any of the iPhone models.
That's right. Yeah.
So the average selling prices hasn't really been increasing that much. And if your user base is growing maybe 3-4% every year and you don't really raise prices, then you have to look to other areas for growth. And right now they're seeing a little bit coming from their services. So if you're talking about
Yes.
Apple TV subscriptions and so on. But because most of the revenue comes from selling iPhones and that's kind of taken a backseat a little bit, they are, in terms of revenue growth, a little bit weaker compared to the rest. On the flip side, I don't want to keep talking about Nvidia, but if people keep wanting to invest in AI and there's the need for their AI GPUs, I mean, one GPU that they're selling is like $30,000. So if you just calculate how many units are being sold.
I don't need to. I think that number alone was mind-blowing.
Yeah, I mean, it's very different compared to a consumer NVIDIA GPU that we have in our computers.
Exactly,
It's
yeah.
maybe like $300, $400.
Yeah, I mean, when governments and private sector companies are buying them wholesale in big volumes, that changes the whole game.
Yeah, I mean, you're talking about like billions and billions of dollars.
Yeah. Wow.
Yeah, I mean, when you just look at earnings calls for Meta, they mentioned that by the end of this year, they want to have 600,000 GPUs, like
That's
worth
just
of
Meta.
GPUs. Yeah. So I mean, you just calculate how much they're spending, 600,000 times 30,000, roughly.
Well,
it's a lot of
Nvidia are
money.
laughing all the way to the bank for like the next few years. So it's really the growth story that matters here because it's the mileage that it gives you as an investor.
Yeah. It's really a growth story.
Okay. So we talked about how sometimes the tech sector can be quite volatile, but it's not as volatile as other kinds of stocks out there. Still, they've experienced pretty drastic movements in a relatively short period, and we talked about this earlier. Some even believe that there's a performance dispersion that has led to a disproportionate increase in stock valuations relative to the rest of the markets. And I guess when they do that, they're comparing it to equities. Do you think that the Mac 7 are indeed overvalued, overweight?
I don't think as a group they're overweight because the earnings potential is really strong.
Okay.
But if you nitpick, obviously some of the companies probably a little bit more overvalued compared to others. So it's not fair to say as a whole they are overvalued.
Okay.
I mean, if you're looking at other consumer equities or healthcare, other defensives, volatility-wise, tech stocks are out there. So if you invest in them, you really need to have kind of the stomach to be down like 10-15% one day and be okay with it.
Yeah.
Because you know that they can make it back in 3 days.
Yeah, I think it boils down to why you've chosen to invest in that particular company, right? Because like you said, the growth story matters, the value matters, where they're spreading their revenue to, where they're gaining their revenue and reinvesting that revenue as well, right? So the Mac 7 may have had its origins in FANG, as I prefaced earlier, but there are still key differences. The thing that sticks out to me immediately would be Netflix, because I don't necessarily see Netflix as a tech stock per se. It's a very consumer stock. But then the lines are blurred, right? Because a lot of tech companies are consumer driven. So tell us about the key differences here. How do I tell what's a true Mag 7 versus a FANG stock?
So actually the Mag 7, I believe at the time it was coined was because they were the biggest 7 companies.
Right.
Tech companies. So Netflix had, I think, like 60% drawdown in price. So they kind of fell out of it. I think at the time they were maybe only worth like $200 billion. Whereas the rest, they're like closer to 1 trillion.
And I mean, it's chump change if you're comparing it to a trillion.
Yeah, so that's why they got dropped. And also because streaming companies in general, if you take not just Netflix, but maybe even to some extent Disney or Spotify, the way they earn their revenue and the way it translates to earnings is a little bit more constrained because they really bank on just 2 things. One is user growth and 2, raising prices.
Which just happened, by the way.
Yeah. And 3, to a small extent nowadays, they're starting to incorporate a little bit more digital advertising in their business model. But for the most part, right, it's how much dollars can I increase without losing all my customers.
Yeah. So there is that limitation then for companies like the streaming platforms. So economy-driven volatility aside, tech stocks do face some risks, including regulatory risks, purely because of their size and their global reach. And as you rightfully pointed out early in the conversation, because of how new they are in terms of market players. What are some of the regulatory risks, and what's the impact of those regulatory risks on these tech stocks? Immediately, I'm thinking about Meta and the hearing in the US Senate, for example.
Yeah, so there are two main regulatory risks right now, and it's been going on for the last few years. One would be data privacy, because a lot of these companies, they take all your data whenever you use them. And so regulators are trying to draw clear boundaries between what you can and what you can't do. And this has been a relatively new phenomenon where they are using a lot of data, churning a lot of data to drive more insights. Obviously, with the advent of higher compute technology, better computers, we've been able to do that. The second area, which is also very important and has a lot of scrutiny, especially in Europe, is around monopolistic practices.
Right.
And that actually has a bigger impact, I think, because look at companies like Google, they essentially are a monopoly in multiple businesses.
Yeah.
I mean, Google Maps,
Yeah.
Android. So they've gotten so big. And the downside for this regulation is that you'll have a lot of smaller players, maybe smaller news outlets, smaller advertisers claiming that, Google's bullying them.
Yeah.
Because they are so big.
Yeah, correct.
Right, which is a fair argument. In Europe, they take it really seriously. They impose serious punishments up to, I believe, 10% of their revenue from the last year. And then on top of that, they're able to break up the company, or at least try to break up your company into smaller bits. We've seen that actually done in China somewhat, with Alibaba, where what regulators have kind of done. And China's a totally different animal.
Oh,
right?
yeah.
But when you look at Europe and North America, that's kind of the biggest downside risk for a lot of these companies. Because if you break them up, then obviously they don't operate as efficiently. They have to have separate teams. You got to spend a little bit more money. So you lose a little bit of your operating leverage, and a little bit of your synergies.
Yeah.
And investors just don't really want it because, if I'm going to invest in a company that's so big, I don't want them to be broken up at all.
Exactly. Yeah.
They lose all their competitive advantages.
Yeah, exactly.
So those two will be the main risks in terms of regulatory oversight. Another risk that's actually quite important nowadays is your geopolitical risks and what we're seeing with China and the US. US banning a lot of technology, a lot of the high-end chips.
That's right.
So that's really impacted NVIDIA a little bit. Fortunately for NVIDIA, AI demand is so strong that for right now, it doesn't really matter.
Yeah.
But China makes up about 20% of NVIDIA's revenue, so you kind of have that taken away. If you did have strong demand and you were just a regular company, 20% of your revenue gone.
Is a lot.
Like in 3 weeks, essentially, is huge.
It's a big chunk,
Right. So these kind of ongoing tensions, you can't really control it. You just got to sit back and watch and hope that they can work it out. Because as an investor, you have no idea.
What about key person risk? You're looking at the Elon Musks and Mark Zuckerbergs of the world. Is this a potential major risk or pretty minor, you think?
I think for most of the Mac 7, it's pretty minor because they have very strong teams around them. So you have to know when you're looking at a company like this, on top of the financial performance, who's the guy at the top? What kind of character is he?
Is it true that some investors actually buy into the company because of that key person?
Yeah, so this is huge in maybe not so much public equities, but when it comes to private equity, venture capital, that's something they look at because you want to see what kind of leader your CEO is.
Right. So here's the other thing that made the news very recently. Meta announcing that they would be paying its first ever dividend to investors. And word is that Amazon and Alphabet are also going to follow suit. Have they indeed reached that level of maturity in the market where they can pay back their investors, and not just for the 1 year? Once you start doing that, I'm sure investors are going to expect you to continue paying some form of dividend over the next at least 5 years.
Yeah, so definitely it was big news for Meta, and it really showed their maturity as a company. Especially, what happened over the last 3 years when they were just pushing growth, and then it was like, oh no, we're going to focus on efficiency. But when it comes to returning value to shareholders, they've always done that through share buybacks.
Yeah.
Their dividends is not on top of the share buybacks that they're already doing. So they just are splitting the capital allocation accordingly. For example, if they're buying back 100 billion worth of shares, now maybe they're going to buy back 80 billion and then do 20 billion in dividends. By making these kind of strategic moves, it shows what kind of company they're maturing into. And it probably would appeal a little bit more to dividend investors, for example, or for people that would have stayed away in the past because they were unsure of what kind of trajectory this kind of company was heading towards.
Right.
Right now, they've mentioned that they're going to be just doing the quarterly dividends for the foreseeable future. So they've already laid out the lines, we're going to do this. It's not a one-time thing. We're going to continue doing it.
That's a huge commitment.
Yeah, and I think that has given investors quite a lot of confidence. And you can see that in the stock price this year. For
yes,
Meta.
it has surged tremendously. And obviously, it begs the question, have they become too big to fail?
I don't think so. I think they still have to be quite focused, especially if they're doing a lot of investments in R&D and capital expenditure, right? When you grow your assets that much, you still have to be somewhat prudent in terms of how you're allocating money.
Yeah.
There will come a point where their user base is also going to be saturated. Right now, they're at 4 billion users.
Yeah.
I mean, that's like almost 60-70% of the world's population. Right? So how much more can they actually grow in terms of user base?
Yeah.
And then on the monetization side, yes, they're still in the early stages, but they'll peter out a little bit in the next 5 to 10 years.
It almost feels as if AI came at the right time. Like the timing is impeccable, that they're able to leverage on this for the next chapter of their growth story.
I think the AI hype came at the right time because
The
these
hype,
companies have been doing it for the last 10 years.
Yeah, exactly.
It's nothing new to them.
Yeah. So as an investor looking to add a tech stock to a portfolio, what do I need to be paying attention to, particularly deciding on Mag 7? I'm thinking about things like time horizon. You talked about tech stock investors being the kind that needs to have the stomach for it. So I'm not thinking long term here. This has to be a quick turnaround or a medium term outlook. Or can they still be long term stocks that we can invest in?
Actually, for more volatile stocks like tech stocks, you really want to have a longer time horizon because it kind of mitigates a lot of the volatility risk. At the same time, if you have companies like the Mag 7 that fundamentally are very sound, if you look at their financial statements, they're flush with cash.
Yeah.
You know that if anything inadvertently happens, they'll still be able to function. They'll still be able to pay out their investors. And so actually these kind of companies, yes, you can do short-term trading and stuff like that. But if you really want to look long-term, that's probably where you're going to be able to maximize your returns. So then you really have to look at how much value can I get at this current price? If you think maybe I can get a little bit more, you wait for a pullback.
Right.
Because inadvertently it will happen.
Yeah.
And then you find that, okay, this is somewhere where it's a bit more value to me as a company. It doesn't diminish the performance or the capabilities of the company. It's just where you want to enter. And then you just hold it for 10 years. Because I'm quite sure in 10 years, all of these companies are still going to be here.
Oh, yeah. It's hard to imagine a world without them now.
They're game changers. They are tech disruptors for the most part. They're all basically what we use every day.
Yeah, it's almost as if we can't live without them.
Yeah.
So my final question to you is, do you think Mag 7 will still be Mag 7 in 2025?
Yeah, I think in 2025, there'll still be Mag 7.
Right. The strong 7 is still there.
I'm quite confident that this will happen for at least the next 2 to 3 years. They'll still be up there.
Do you think anyone will drop out the way Netflix did?
I think the only company that has the potential to do that would be Tesla. The rest of them, they're very solid. Even though we talked a little bit about Apple and slowing growth, they're still a huge company.
Very high value company.
Very
still.
high value because they generate a lot of revenue. Earnings are also good and they're very stable. It's tough to find a better company than Apple if you're looking for something that's stable.
Right.
It may not give you the 30-40% performance that you want year on year. But
not right now anyway.
Yeah, not right now, but they'll still be pretty solid.
Okay.
Better than most other companies.
You know what? You just gave us a really detailed lay of the land, Jonathan. So thank you so much for helping us understand the Mag 7, the whole tech stock industry, especially as an investor as well, what to look out for. So thank you very much.
Yeah, you're welcome. It was fun.
It's still like very exciting space to watch, however the journey turns out. Just gotta make sure that, you as an investor know what you can stomach, as Jonathan painted. If you enjoyed this episode, please let us know by leaving us a comment or a rating on any of the platforms you are listening to us from. We're streaming on Apple Podcasts and Spotify, as well as YouTube Music. Let's not forget the team behind Money Talks: Joanne Chan, Tiffany Ang, Jonaini Johari, Crispina Roberts, Saya Wint, and I'm Andrea Heng. Catch you next time.